So yeah, I would think that real estate builds wealth the fastest, and here's why. So I would think in terms of safety as well, right? It builds wealth fast, but it's safe. It builds wealth fast in a safe way. Like sure, you can win the lottery, you could get lucky on crypto, etc. But for most people, I think real estate could be the key. Now, there are 3 to 4 main reasons why. And I think the first one that's dramatically different is the kind of financing that you have access to in real estate. And the word I'm going to use it is called leverage, right? To use other people's money in a certain sense. So you cannot really do that as safely in the stock market for the average person. So for instance, in real estate, you could take out in the US, you could take out a 30-year fixed loan. It's not callable. As long as you're paying your monthly mortgage or your renters are paying your mortgage, you're not going to be called all of a sudden. Now, this was different. I know if you're a fan of Dave Ramsey, in the 1980s, he was taking out these short loan options that were callable. And so, if the loan company can just basically, or your lender can just tell you, I want all your mortgage right now, that can scare you off ever wanting to borrow ever again. But with a 30-year fixed loan, I mean, it's there you're spreading it out over 30 years, you're amortizing, as they say, but it cannot be called right now. Unlike in stocks, like, yeah, you can get leverage in stocks to a certain extent, like margin accounts and things like that. And to a certain extent, options, futures, you have that. It's a bit more advanced. But typically, if the value of your account falls underneath a certain threshold, right, depending on what you're doing, the investment bank or the brokerage can just suddenly wipe out your account, liquidate your account at a lower, like sell it at a lower price. So you're giving the money back, but only a certain amount of it, right? So it can be sucked. So I really think that that's the difference, is that you're not going to be having these callable loans with a 30-year fix. So that's huge. And also, you might say, well, Michael, in real estate, you might get 3%, you might get 6%, returns. And in the stock market, even in the index fund with much less work, I might get like 7 to 12%. Let's call it 10% for fun. Okay, but here's the thing. With just $10,000, you can control, with something like an FHA loan, you can control a $250,000 property, right? If you've got seller credits, maybe even a grant for closing costs, you can get in for $10,000 into a property that's worth $250,000. So 3% appreciation, right, is going to be about 7,500. You put down 10, but you've made 75% right there and then, right? That's 7,500 or 7,500. That 3%, okay, in the stock market, you'd have to have a 250,000, not 10,000. You'd have to have a 250,000. And I hear you. If I put a 250,000 cash into a home to get 3%, yeah, that would kind of suck, right? Or 6% even, like, if I was getting double that. But in that case, I'd be getting 15,000. That's 150%, right? On that original 10,000 I put into a house. So it's not even comparable, versus your 10% in your index fund. So leverage is the first. If you can do it safer, it's not callable. It's the major advantage of real estate. You just can't typically do that without blowing up your account in the stock market. Now, before some of you really advanced day traders get at me, yeah, there are ways, but it's not for everybody. It's for like 0.1% of the population, okay? Whereas in real estate, almost anybody can do it. So it's much safer. You get a huge amount of leverage. That is number one. And I think another thing, number two, is probably the tax benefits. They're huge. You can't really underestimate them. So tax benefits would be massive in real estate. You don't have the same tax benefits, let's say, in the stock market as you do in real estate. So for instance, when the property goes up in value, the appreciation, I love that. I love when there's an appreciation because I don't pay tax until I sell the property. And if I sell the property, well, I could 1031 exchange it in the US. So I could defer paying the tax. I can get another property as long as you follow the guidelines. And then the next time I sell it, I can do another 1031 exchange, and I can literally do this until I die, right? And there's a huge amount of things like that in terms of tax benefits. Also, just in terms of the write-offs. If I have a property, let's say it's a rental property, I can write off part of the insurance, the interest rate payments, the expenses. And I also get depreciation. So I take the property value, subtract the land value, again, it's to do with the assessment, etc., and if I put more things into it, it can drive that up. I divide that difference, right, between the property value, the land value, roughly for residential by 27.5. Now you want to consult with the CPA that it's different for commercial, it's different for different types of properties, but rule of thumb is, okay, well that's giving you thousands potentially of dollars a year that you can subtract from all the other sources of income that you have, and it can lower your tax bill. It's huge. There's a massive amount of tax write-offs in real estate. The government is trying to encourage people to provide housing. So tax is colossally helpful. It's beneficial. The tax benefits are massive in real estate, unlike in stocks and a lot of other areas. Now, one thing I like to do is not just rely on the market appreciation. I love market appreciation. That's why I love good quality neighborhoods, because getting high rent, high yields is just not my thing. I don't like cheaper areas because the property values are not going to go up. You're getting compensated by a good yield, but that yield, that income you're making, you're paying more tax on that because that's more almost active income. Like that's exposed, unlike the value of the property that's crawling up over time. So I'd rather have a property that's rising in value than a property that's generating a huge amount of cash flow. Now, I'm not talking about negative cash flow, so when your income is less than your expenses, but I'm meaning that, like, look, if you get a place in the middle of nowhere, or a really class D, class C even neighborhood, that's really dangerous neighborhood, you're getting compensated. It's like a dividend stock. You can think about like a cheap stock. Like there's a lot of cheap stocks out there that are not that good. They're not blue chips. They're really small cap, tiny stocks. They're almost like penny stocks, and they might pay you a huge dividend. But if you hold that company for too long, you might discover that it goes to zero, right? The company goes bust. It's the same thing in real estate. You might be getting a good dividend, a good income, or a good cash flow, etc. But cash flow isn't everything. Appreciation is more hidden from taxes. That's why I'm personally in favor of better quality neighborhoods and having the appreciation, and then not paying taxes by doing a 1031 exchange legally, everything legally, things like that. So that's forcing the appreciation. When you go into a property, you do it up, and then you go to an assessor or an appraiser or a lender if you want to take a loan against the property, and you say, hey, I've improved the cosmetics. It was awful. There was mold, there was ugly carpets, there was, really terrible, paint job, etc. Or maybe it was like a wallpaper, and now I've put in brand new countertops. They're granite, they're quartz, they're whatever. I've got new lovely lighting. I've gone from 1970s gold hardware on the doors to now it's something like a lovely black bronze, oil rub bronze, or a nickel, brushed nickel, things like that, those kind of doorknobs. All the hardware is consistent. I've made the place look 21st century. It used to look like mid 20th century. So I've raised the property, if it's a single family or an apartment, something like that, right? And you could get the actual property reappraised based on that. And then you can take out a loan against it. When you take a loan against your property, you don't pay tax on the loan. It's not taxable. So there's so many ways like that. I love forcing the appreciation. And the multifamilies, it's being able to raise the rents. If you can raise the rents, the actual value of the property is a multiple of the rents. So the more you can raise the rents, again, I'm not saying it being a really nasty landlord. I'm saying raise it to market, like what's fair. So getting a property where maybe for whatever reason the rents are under market, then doing a few little things, a few little improvements. It's not even just the rent. It's even things like, well, maybe you had some garages and now you can actually rent out the garages that are part of the property. Maybe there were coin-operated laundry machines that weren't being managed. So now they're fixed and now you can get that income once again. Maybe there's more storage space you can rent out. Whatever your gross income is, getting that up, etc., right? So that's kind of leading into the final thing. I think cash flow almost at the last situation. Like, yeah, you can do short-term. I do a lot of short-term rentals. That'll build your cash flow. That's wonderful as well. And your tenants are paying your mortgage. Like, you might think, oh, well, you got a lot of debt and you're paying a lot. Yeah, but I'd rather, like, they're paying my debt, right? So every month, think about it like this. Every month, they're basically paying down my mortgage. So my debt, right, the actual interest is going down a little bit. Like the next month I'm paying less and less and less of the actual mortgage. And every month the actual principal, the equity, owning it, I'm paying a bit more towards that. More of my payment is going towards owning the property and a smaller amount is going towards interest over time, right? And this is where it really goes up over time, the value of your property and also as you're paying like that. So it really does help over time. And the cash flow is great. Look, I don't knock it too much. Like, I love cash flow. I love it, right? But other things too. So look, this is why I think it just doesn't compare. There's so much under the iceberg with real estate. And especially for people that are just starting off, they don't have a lot of money, or even if you do and you hadn't really considered it, this can really catapult your net wealth. It happened for me. And look, I don't like talking from theory. I like talking from practice. It worked for me. I catapulted myself in my first property by over 100,000, in my second property by about 300,000, like that, right? In terms of net wealth increase from changing the value, from doing something to the property and then getting it reappraised. It is incredible. And over time, it's like as you get more and more properties, it's a little bit like the stocks, like you're building it, it does increase over time, but you get way better tax benefits, you get that leverage and everything else. So again, I'm teaching from my own personal experience, sharing it with you totally free. I love it. That's my goal. If you can just benefit a little bit, just one iota, if you can avoid my mistakes, just even copy from my success. And if it can help you, then all the merrier. And by the way, speaking of helping you, if you want my help, I've created a free guide. You can click below to download the free guide. It's called the $10,000 Property Playbook. And it shows you how to get into your first property for just $10,000, how to do it up, things like that, how to make more money out of it, and how to get into your next deal. Because your first shouldn't be your last. And you should think about it like you don't have to get them all at once, just one at a time. So let's build wealth one property at a time, and I'll see you in the next one.